Welcome to today's explainer. There's a date on the calendar that basically decides exactly how much money stays in your pocket this year. And wild enough, most Australians just sleepwalk right past it. June the 30th. Miss it, and the tax office gets to keep thousands of dollars that should absolutely be sitting in your bank account, padding out your super or securing your future. But hit it the right way, and you'll walk into July feeling lighter, richer, and finally in control. The crazy, frustrating part? None of this is hidden. The rules are public, the deductions are completely legal, but every single year, millions of Aussies leave money on the table just because nobody sat them down and explained what to actually do before the clock runs out.
Thousands of dollars. I want you to let that sink in for a second. We are talking about the exact amount of money people just leave sitting on the table every single year. And look, I get it. Tax feels boring. It feels complicated. It kind of feels like something you should just dump into a shoebox and hand over to a professional once a year, right? But ignoring it until tax time is exactly how you end up losing this much of your own hard-earned wealth.
And here is the harsh reality. Your accountant is completely powerless in July. The financial year does not care about your good intentions. Accountants can only work with what you bring them. If you haven't put things into motion by June the 30th, there is absolutely nothing they can do in July to fix it. So let's fix that today. We're going to cover 5 strategic moves you can make before the clock runs out to rescue your money, even if you've never thought about tax beyond your annual return.
All right, let's dive straight in with move 1, superannuation, and specifically, topping up your cap. This is arguably the single most underestimated move you can make. For the 2025 to 2026 financial year, the concessional cap sits at $30,000. Now, that includes what your employer pays in, but for most working Australians, there is still very meaningful room underneath that ceiling. And the math here is just incredible. Money you put into super from your pre-tax income is generally taxed at just 15% inside the fund. Compare that to your marginal tax rate. For a lot of middle-income earners, that's 30% or 32.5%, and for higher earners, it climbs to 37% or even 45%. That massive gap, that's your saving. If you put $10,000 in as a personal deductible contribution, depending on your bracket, you could literally cut your tax bill by $2,000 to $3,000 in one single move. But wait, it actually gets better. If you haven't used your full cap in previous years and your super balance is currently under $500,000, you might be able to carry forward unused amounts from the last 5 years. You are essentially stacking your deductions here. For someone who's taken time off work, maybe run a small business through a lean year, or, just never got around to topping up before, this rule alone can be absolutely life-changing at tax time. But you are up against a ticking clock. The money has to actually land in your fund before June 30th, and you've got to lodge a notice of intent to claim with your fund before doing your return. Leave this to the last week of June, the danger zone, and you seriously risk the payment not clearing. Banks process super transfers through clearinghouses, and those clearinghouses do not work weekends or public holidays. So the safe move? Transfer that money by the 3rd week of June at the absolute latest.
Okay, moving right along to move 2, working from home and what I like to call the 70-cent half. This one is built for anyone who works from home, even if it's just part of the week. For the 2025 to 2026 year, the ATO's fixed rate method lets you claim 70 cents for every single hour you worked from your house. But there is a catch. The ATO is incredibly strict about records now. You need a diary, a timesheet, or a roster showing your actual hours. If you've been a bit slack with this, don't panic. You still have time before June 30 to reconstruct your hours from emails, calendar invites, or login records. Plus, if you bought a desk chair, a monitor, or a laptop for work, those can be claimed separately on top, either in full if they're under $300 or depreciated over time if they cost more. Keep in mind the actual cost method is still available too, and for some people it gives a bigger deduction, especially if you have a dedicated home office and high power bills. It just takes more paperwork, so weigh up which approach actually suits you best.
So what does this actually look like in your pocket? Well, between $600 and $900. For someone working from home just 2 days a week, that 70-cent claim alone yields that much in deductions. That's essentially free money just for keeping track of the hours you're already working in your own living room or home office. Now, I've got a quick question for you. Are you expecting your income to drop next year? Maybe you're going on parental leave, taking a much-needed sabbatical, or just stepping back from work a bit. If you answered yes to any of those, this next move is perfectly tailored for you. Let's look at move 3, prepay expenses, or pulling next year's deduction forward. This strategy totally flies under the radar for most employees, but it can shift your refund noticeably.
If you prepay deductible expenses before June 30th, you lock in the deduction at your higher current tax rate. You can prepay up to 12 months in advance for things like income protection insurance held outside of super, professional memberships, union fees, industry journal subscriptions, and in some cases, interest on investment loans if you're an eligible individual. The principle is beautiful and simple. You're just pulling next year's deduction into this year's return. That timing alone can be worth hundreds, sometimes over $1,000. But a quick tip here, before you prepay anything, do a quick 5-minute call to your accountant to ensure the ATO considers it genuinely work-related for your specific situation. A 5-minute call is way cheaper than getting it wrong and having the ATO reject your claim.
All right, let's jump to move 4. Genuine donations, and why DGR status really matters.
This one is for anyone who gives to charity. Donations are fully claimable, but only if you donate before June 30th, and only to organizations with deductible gift recipient, or DGR, status. Let's break down the numbers. Say you're in the 32.5% bracket and you make a $500 donation. It isn't really costing you $500. After the tax deduction, your real cost is actually closer to $337, while $163 comes back as a tax deduction. You're doing a fantastic thing by supporting a cause you care about, while simultaneously legally reducing your tax bill. A total win-win. But you've got to beware of the common mistakes here. No workplace tins, no raffles, no event tickets. You cannot receive any material benefit in return for your donation. It has to be a genuine gift. Check the status on the ATO's website before you donate, and please screenshot your receipts the very second they land in your inbox. If you've donated small amounts across the year on various platforms, log into each one right now and pull your year-to-date summaries. And now we arrive at our final strategy, Move 5, health insurance and property, and how to beat the surcharge. This is a 2-part move to avoid vicious ATO penalties and unlock hidden property deductions. Let's kick off with health insurance. If you don't hold private hospital cover, the ATO will penalize you through the Medicare levy surcharge. If you earn over $101,000 as a single or $202,000 as a family, you get hit with an extra 1 to 1.5% of your entire income as a surcharge. To put that into perspective, on a $120,000 salary, that is up to an $1,800 penalty just gone, right on top of your normal tax. Now here's the kicker. A basic hospital policy often costs significantly less than the $1,800 surcharge itself. Take out cover before June 30, and you can come out in front, sometimes by $1,000 or more. And because the surcharge is calculated day by day, getting cover sooner literally saves you more money. And for part 2 of this move, if you own an investment property, you need to get a tax-deductible depreciation schedule immediately. This is your window. The fee for getting one is tax-deductible, and a proper professional schedule can unlock thousands of dollars in unknown deductions that you didn't even realize existed, right there in the walls, floors, and fixtures of your property. We've covered a lot of ground today, but I really want to leave you with this reality check. Like I said earlier, the financial year doesn't care about your good intentions. None of these legal deductions work if you wait. Super contributions need to clear, insurance needs to be paid, donations need to be processed. Everything must be fully locked in by the deadline. There are absolutely no extensions and no grace periods. The ATO only counts what is actually done. So let's turn this explainer into action with a final plan. First, open your Notes app on your phone right now. Second, write down which of the 5 moves we just discussed actually apply to you. And third, book a single afternoon this week to execute them. That is usually all it takes to move thousands of dollars from the tax office right back into your own future. And remember, once you do this once, you'll know exactly what to do every June from here on out. Learning these moves isn't just a one-off win. It becomes a yearly habit. And that habit, it compounds into tens of thousands of dollars kept in your own pocket across your entire working life. So I'll leave you with this provocative thought. Will you let June 30th pass you by again, or will you take back control of your thousands? The clock is ticking, but the power is entirely in your hands. If this explainer helped you see June 30 differently, do me a huge favor and hit that like button. And if you want to keep learning the systems that control your money, make sure you subscribe and turn on notifications so you never miss an update. Get out there, make your moves, and I'll see you in the next one.